In the last couple of months, you must have read in the news or from a friend or relative how interest rates are rising all around the world and how the central bank of your country was responsible for this. With inflation out of control, central banks raised these rates as a measure to try to control it. But what is a central bank? How do they decide how to change the interest rate of a country? And most importantly, how does this affect your wallet? According to the European Central Bank, a central bank is a public institution that manages the currency of a country or group of countries and controls the money supply. The main objective of many central banks is price stability. In other words, a central bank is an organization that regulates the amount of money moving within a country. In practice, this means that the main goal of a central bank is keeping inflation in check. Inflation occurs when the prices of goods and services rise. That is, when you can buy fewer things by spending the same amount of money. To prevent this, a central bank uses what is called monetary policy. Monetary policy is a set of tools that a central bank has to control the overall money supply and promote economic growth. In countries like the United States, their central bank, the Federal Reserve, uses monetary policy through a dual mandate looking to maximize the employment rate while keeping inflation levels stable, generally at a target of around 2% per year. So how does a central bank regulate inflation? The main tool they use is interest rates. A central bank is not a commercial bank. An individual cannot open up an account at a central bank. Instead, it functions as the bank's bank. Commercial banks have accounts with the central bank where they can lend and borrow their cash. By adjusting what interest rates the central bank charges to the commercial banks, they indirectly impact the interest rates end users are charged on their loans, such as mortgages or automobile loans. For example, if the central bank increases their policy interest rate to 5%, commercial banks will charge at least 5% to end consumers. Otherwise, the commercial bank would be better off just lending its money to the central bank with zero risk of default. Another way central banks can conduct monetary policy is via reserve requirements. Reserve requirements are the minimum amount of money that banks must keep on hand as a percentage of their total deposits. For example, in the United States, the reserve requirement is typically 10%, meaning that for every $100 deposited into an account, the bank must hold at least $10 in cash or other highly liquid assets. By increasing or decreasing the reserve requirement, the central bank can change how much loans commercial banks can give out for a given level of deposits. Adjusting the reserve requirements has a similar effect as adjusting interest rates, so we'll focus on interest rates for the remainder of the video. There are two kinds of monetary policies: contractionary and expansionary. A contractionary policy occurs when the central bank increases interest rates while limiting the excess money supply to slow the economy's growth and decrease inflation. On the other hand, an expansionary policy occurs during times of economic slowdown or recession. An expansionary policy increases economic activity. By lowering interest rates, saving money becomes less attractive, incentivizing consumers to spend their money while increasing the number of loans and the amount of borrowed money. Monetary policy affects the real economy via multiple channels. Firstly, an expansionary monetary policy decreases unemployment. Low interest rates stimulate business activities and the expansion of the job market. Secondly, the exchange rates between domestic and foreign currencies can be affected by monetary policy. When interest rates are lowered, holding domestic bonds becomes less attractive, and investors will buy foreign bonds instead. To buy foreign bonds, they need to sell their domestic currency for foreign currency, which causes a depreciation of the exchange rate. And perhaps most importantly, monetary policy impacts inflation. If interest rates are low, people have more money to spend because they can borrow more money. Also, the depreciation of the exchange rate increases the prices of imported goods, further fueling inflation. And, of course, increasing interest rates will decrease the rate of inflation via the same channels. So, in summary, a central bank tries to prevent or reduce inflation by managing interest rates. But what causes inflation? Broadly speaking, there are two main causes of inflation: cost-push inflation and demand-pull inflation. Demand pull inflation is the result of an increase in demand for goods and services outpacing the available supply. For example, if interest rates are low, people can borrow a lot of money. As they spend this money in the real economy, this causes prices to rise as businesses are incentivized to increase the cost of their products due to increased demand. Conversely, cost-push inflation is caused by an increase in production costs that leads to higher prices for consumers. For example, let's say a government instituted tariffs on imported goods. This increases the cost of the goods. Businesses will increase prices to consumers to protect their profit margins. This causes inflation even if there is no change in demand. Whether inflation is caused by demand pull or cost-push inflation, the solution to fixing it is the same. If demand is too high, the central bank will raise interest rates to reduce demand to more sustainable levels. If the economy is suffering from cost-push inflation, the central bank will still increase interest rates to reduce demand. If demand falls far enough, prices will go back down as businesses will be forced to reduce their prices even if production costs are higher. And finally, in addition to regulating interest rates, central banks also act as a lender of last resort. The Federal Reserve's discount window is a lending facility that provides liquidity to financial institutions in times of need. The Federal Reserve provides banks with access to loans at the discount window, which are usually at below market rates. Banks may borrow funds from the discount window for up to 90 days, and the purpose of these loans is typically to help meet liquidity needs. The Federal Reserve also has an emergency lending program, known as the Primary Credit Facility, which allows more distressed banks to borrow funds at a slightly higher rate than those borrowing through the discount window. During the 2008 financial crisis, the US Federal Reserve lent money to American banks including Goldman Sachs, JP Morgan Chase, Morgan Stanley, Bank of America, and Citigroup. Similarly, the UK's Bank of England lent over £37 billion to Lloyds in 2008. Many economists believe some, if not all, of these banks would have collapsed without this support.